Hold on to your hats, folks. Today, all eyes are on the Federal Reserve. They're meeting to make a decision that could send shockwaves through the stock market, the crypto world, and even your own pocketbook. It's like the final rose ceremony of the financial world, tense, unpredictable, and with potentially life-altering consequences. This isn't just another boring meeting of suits in a stuffy room. What the Fed decides today will determine if your investments grow, shrink, or take a nosedive. It's about the value of your dollar, the cost of borrowing money, and the overall health of the economy. So, buckle up and get ready for a wild ride. This is one meeting you can't afford to ignore. We're going to break it all down for you so you can understand what's at stake and how to protect yourself. Remember, knowledge is power. And in the unpredictable world of finance, a little knowledge can go a long way. Let's face it, the markets have been acting like a teenager on a sugar rush lately. Up one minute, down the next, and completely unpredictable. One day, it's all green lights and champagne wishes. The next, it's red alerts and panic selling. Investors are understandably nervous. The economy is sending mixed signals, inflation is still stubbornly high, and the war in Ukraine continues to rattle global markets. It's like trying to juggle chainsaws while riding a unicycle, stressful, to say the least. This uncertainty has everyone on edge, wondering if we're headed for a correction, a crash, or just a bumpy ride. And the Fed's decision today could be the catalyst that tips the scales one way or the other. So what's causing all this market volatility? Well, it's a perfect storm of factors brewing together: geopolitical tensions, rising interest rates, and a general sense of unease about the future. Now let's talk about interest rates, the Fed's weapon of choice for trying to tame the wild beast that is the market. The Federal Reserve, often simply referred to as the Fed, has a significant influence on the economy through its control of interest rates. This lever is one of the most powerful tools in its arsenal, and it's used to either stimulate or cool down the economy as needed. Think of it like this: interest rates are the brakes on the economy. Just as a driver uses brakes to control the speed of a car, the Fed adjusts interest rates to control the pace of economic activity. When the economy is overheating, much like a car going too fast, the Fed steps in to apply the brakes. When the Fed raises interest rates, it becomes more expensive for businesses to borrow money. Higher interest rates mean higher costs for loans, which can lead businesses to think twice before taking on new debt. This can result in reduced spending on expansion, hiring, and other growth activities. This can slow down economic growth, cool down inflation, and potentially put a damper on the stock market. Investors may become more cautious, leading to a decline in stock prices. The ripple effect can be felt across the economy, as reduced business activity can lead to lower consumer spending and slower overall growth. On the other hand, when the Fed lowers interest rates, it's like stepping on the gas. Lower interest rates reduce the cost of borrowing, making it more attractive for businesses and consumers to take out loans. This can lead to increased spending and investment, which can boost economic activity. Borrowing becomes cheaper, businesses are encouraged to invest and expand, and the market tends to respond favorably. Lower interest rates can lead to higher stock prices, as investors anticipate stronger corporate earnings and economic growth. But like any powerful tool, interest rates need to be used carefully. The Fed must balance the need to stimulate the economy with the risk of causing inflation. Too much stimulation can lead to rising prices, which can erode purchasing power and hurt consumers. Raise them too high, and you risk pushing the economy into a recession. High interest rates can stifle economic activity, leading to job losses and business closures. The challenge for the Fed is to find the right balance that supports growth without triggering a downturn. Keep them too low for too long, and you fuel the flames of inflation, eroding the value of your hard-earned money. Inflation can be particularly harmful to those on fixed incomes, as their purchasing power diminishes over time. The Fed must be vigilant in monitoring inflationary pressures and adjusting rates accordingly. So, you see, the Fed is walking a tightrope. The task of managing interest rates is a delicate one, requiring careful consideration of a wide range of economic indicators. The Fed's decisions can have far-reaching consequences, affecting everything from mortgage rates to the cost of credit cards. They need to find that sweet spot, the Goldilocks zone of interest rates, that will keep the economy growing without letting inflation spiral out of control. This optimal rate is not too high to stifle growth, nor too low to ignite inflation. It's a constant balancing act, and the Fed's ability to navigate this complex landscape is crucial for maintaining economic stability. Section 4. Inflation's Bite. Why your dollar isn't stretching as far. Inflation is the silent thief in your wallet. It's not something you can see or touch, but you can definitely feel its impact. Every time you open your wallet and find it emptier than expected, that's inflation at work. It's the reason why that cup of coffee that used to cost $3 now costs $5. You might think it's just a small increase, but over time, these small increases add up, making a significant dent in your budget. And why filling up your gas tank feels like you're taking out a second mortgage. The rising cost of fuel doesn't just affect your commute, it impacts the price of goods and services across the board, from groceries to shipping costs. We've all felt the pinch of inflation in our daily lives, whether it's at the grocery store, where prices seem to climb higher every week, or when paying bills, the cost of living is steadily increasing. It's the reason why you might be thinking twice about that vacation. Travel costs have soared, making it harder for families to afford a getaway. The dream of a relaxing holiday is becoming more elusive. Putting off that home renovation is another consequence. The cost of materials and labor has skyrocketed, making it difficult to justify the expense. Projects that once seemed manageable are now out of reach, or just generally feeling like you're working harder but getting ahead less. Despite putting in long hours and extra effort, your paycheck doesn't stretch as far as it used to. It's a frustrating reality for many, and it's a major concern for the Fed. The Federal Reserve is tasked with maintaining economic stability, and controlling inflation is a key part of that mission. They use various tools and policies to try to keep inflation in check. Their mandate is to keep inflation under control, but it's a delicate balancing act. They have to consider the impact of their decisions on employment, interest rates, and overall economic growth. And right now, it's like trying to wrangle a bucking bronco. The forces driving inflation are complex and often unpredictable, making it a challenging task for policymakers. The Fed knows that if inflation gets out of hand, it can be devastating for the economy. It erodes purchasing power, discourages investment, and creates uncertainty. Businesses may hesitate to expand, and consumers may cut back on spending, and can lead to social unrest. When people struggle to afford basic necessities, it can lead to frustration and anger. Protests and social movements often arise in response to economic hardship. Remember the runaway inflation of the 1970s? It was a time of economic turmoil, with prices spiraling out of control and long lines at gas stations. The lessons from that era still resonate today. Yeah, nobody wants to go back there. The goal is to learn from the past and implement policies that prevent such extreme inflation from happening again. It's a continuous effort to maintain economic stability and protect the value of your dollar. Section 5. Crypto in the crossfire. Will digital currencies weather the storm? Now let's talk about the new kid on the block. Cryptocurrencies. These digital assets have taken the financial world by storm, offering a new way to think about money and transactions. From Bitcoin to Ethereum and Dogecoin, these currencies have captured the imagination of investors and tech enthusiasts alike. Bitcoin, Ethereum, Dogecoin, these digital currencies have been making headlines and shaking up the financial world. Their decentralized nature and potential for high returns have made them attractive to a wide range of investors. But with great potential comes great volatility. But how will the Fed's decision today impact the crypto market? The Federal Reserve's policies have far-reaching implications, not just for traditional markets, but for the burgeoning world of digital currencies as well. Investors are keenly watching to see how interest rate changes and monetary policy adjustments will affect their crypto holdings. Well, that's the million-dollar question, or should I say, the million Bitcoin question. The relationship between cryptocurrencies and traditional financial policies is complex and often unpredictable. While some see digital currencies as a hedge against traditional market fluctuations, others view them as highly speculative assets. Cryptocurrencies have often been seen as a hedge against inflation and a safe haven from traditional markets. In times of economic uncertainty, many investors turn to digital currencies as a way to protect their wealth. However, this perception is being tested as the market evolves. But lately, they've been moving in tandem with the stock market, suggesting that they're not as immune to the Fed's actions as some might think. This correlation has raised questions about the true nature of cryptocurrencies as a separate asset class. Are they really a hedge, or just another player in the broader financial ecosystem? If the Fed raises interest rates, It could make riskier assets like crypto less appealing to investors. Higher interest rates generally lead to higher returns on safer investments like bonds, making them more attractive compared to the volatile crypto market. After all, why gamble on Bitcoin when you can get a decent return on a less volatile asset like bonds? This shift in investor sentiment could lead to a decrease in demand for cryptocurrencies, potentially driving prices down. On the other hand, if the Fed holds steady or even cuts rates, it could be seen as a green light for crypto, potentially pushing prices higher. Lower interest rates often lead to increased liquidity in the market, which can drive up the value of riskier assets like cryptocurrencies. The bottom line is that the crypto market is still young and unpredictable. Its rapid growth and the constant influx of new technologies and regulations make it a dynamic and often volatile space. Investors need to be prepared for the unexpected. It's anyone's guess how it will react to the Fed's decision today. The interplay between traditional financial policies and the emerging world of digital currencies is still being understood. Each new development brings with it a wave of speculation and analysis. One thing's for sure, though, it's going to be interesting to watch. As the world of finance continues to evolve, the role of digital currencies will undoubtedly be a key area of focus. Whether they weather the storm or not, their impact on the financial landscape is undeniable.